So the next type of chart that we'll discuss is the candlestick chart. So this is yet another visual representation of price action of a trading asset. There's a lot of different types of charts. We're just going to focus on these two because these are the most basic and the most relevant. Candlesticks are probably the most used type of chart in regards to trading and price analysis. So knowing this, really, you can argue that you really don't need to know anything else in terms of different charting styles. Now, the main benefit of a candlestick chart is that it displays the opening price, the highest price of the time period, the lowest price of the time period, and the closing price of the time period. So whether that's the hour, we get to see what price opened at. We get to see the highest price within that hour. We get to see the lowest price of that hour. And we also get to see where the asset closed within that hour. Now, just to restate, each candlestick represents a different period of time depending on the chart settings, right? So a chart that's based on 1 hour intervals will show multiple candlesticks that represent 1 hour of price movement. If you select the 5-minute time period, each candlestick will represent 5 minutes of price movement. So you'll see a different picture depending on the time frame that you select. So here is the anatomy of candlesticks. Typically, there are two types of candles. We see a bullish candle, which is typically colored in green. Sometimes you may see them in white. That's an older style of visualizing candles. But typically you'll see green candles, and then also the bearish candle, which is red, representing a downward in price. A green represents that price went up over that time period. Red represents that price went down. Now, we also see that there is the main part of the candlestick, which is the body, this fat part, this filled in part. And in a bullish candle, a green candle, the opening price is at the bottom of the body, this bottom line. This is where price opened at, where let's say if this is on the daily and on Tuesday we see a new candle open up. It would open here, and the closing price, the price that the asset closed at the end of the day or at the end of the hour, depending on the candlestick, would be the top part of the body in a green candle. Now, this already tells us, and this is part of the reasoning behind green candles representing that price went up. If the green candle open is at the bottom of the body and the close is at the top of the body, this already tells us that price went up, right, during this time period. And that's why it's colored green, right? If the price opened here and closed here, it had to have gone up over time. So this is why we color it green. And we see that in reverse on the bearish candle, where the opening price is the top part of the body and the closing price is the bottom part of the body. This represents that price went down and actually closed lower than what it opened, right? If price opened up at 44K each Bitcoin and then it closed to 43K each Bitcoin, it would be a red candle. And it does not matter the size of the drop. This could be a significant percentage decrease or a significant or a very small percentage increase. Even if it's a 1% decrease in price, it would still be a red candle. Now the body might be not be as big, but it would still be red or it would still be green if price went up. The next thing that we'll want to point out are these small lines. So these are called wicks. Sometimes they're referred to as shadows. This is how we can tell the highest price of the asset at that time. So let's say price on Bitcoin opened up at 42,000 and it closed at 43,000, right? But at some point, Bitcoin went up to 44,000. The wick on the top part of the body, the wick at the top part of the body would tell us where price went to, and would tell us the highest price point of the asset at that time. This remains true on the bearish candle as well, where the top wick represents the high. On the bottom side, this lower wick, this would represent the extreme low of price. Now, if price opened here and fell below, this wick would be filled. And even if it was a green candle, let's say this green candle, and we opened at 42K, we closed at 43. At some point, we went to 44, right? At some point, we know that because this wick went up here and it's lined up at 44, we know that Bitcoin at some point, it opened up at 42. It went past its closing point because if the candle's still active, it hasn't actually closed yet. Bitcoin went up to 44 and ultimately came back down to 43 and closed. Now, likewise, if Bitcoin opened at 44 and at some point price dropped down to, let's say, 40,000, this wick would tell us that. So at some point, price fell below the open, but still managed to come back up and close higher. And this is important to notice with green candles and also with red candles. We also want to factor in, let's say price opened at 40,000. At some point, it went higher than the opening price because we can tell by this top wick. Even if it went up, price still fell at some point because the candle's red and the close is lower than the open. We can also tell that price fell even lower than the close if there's a bottom wick, and we can tell exactly where it fell to and what the extreme low was for that time period. So the color of the candlesticks will change depending on if the asset price closed higher or lower than its opening price. Green candlestick represents the positive price increase in that time period. The closing price was higher than the opening price. The red candlestick, we saw a negative price decrease in that time period. Closing price was lower than the opening price. The candle body, this will shift open and close position depending on red or green. Where we saw with the green candle, the lower body is the opening price and the upper body is the closing price. Price went up, right, from the opening to the closing time period. In a red candle, we see the opposite, where the upper body is the upper body, sorry, this is incorrect. The upper body should be the opening price and the lower body is the closing price. The price went down from open to close. Now, in regards to wicks, here we see wicks are these lines above and below the candle body. We have the upper wick, which is the highest traded price. That is on top of the candle. And we have the lower wick, which is the lowest trading price, the lowest traded price on the bottom of the candle below the body. And this is the same whether or not it is a red or green candle. Now, one of the best perks of the candlestick chart is the OHLC, or open, high, low, and close. Color-coded candles can make price analysis easier or clearer, more obvious if price went up or went down during that time period. And this is done through the OHLC, the open, high, lower, close. So when you hover over a candlestick on TradingView or really any other trading analysis charting platform, when you hover over the candlestick, you will see these figures: the opening price, the O, the high price, the low price, and the closing price. Not only is this shown on the actual candle itself through the formation of the candle, but when you hover over it, you'll also see the numerical values of these figures as well. Now, the open, high, low, close is useful, very useful for mapping higher time frame, HTF, openings and closings. So think about the weekly open or the daily close. I need to see where Bitcoin's price is closing on the daily. These are generally more important closings and openings that we want to consider as traders on a more macro view, on taking a look at the bigger picture. When we want to take a look at the bigger picture, we want to look at these higher time frames, such as the weekly or the daily, and see where price is opening and closing to kind of give a more clear indication of where price is going. We also can find exact highs and exact lows of a candle or a pattern or a trend, right? If Bitcoin perhaps made some sort of extreme move up to 65K and then ultimately came back down, we can pinpoint that exact high, even if it wasn't necessarily a closing position, right? We can say, oh, well, on April 28th, it produced this new all-time high. As opposed to just seeing the closing prices on the line chart, which may not even show those highs, because the line charts won't factor in those extreme highs. It won't factor in a wick above. It just only factors in closing prices for the time period. It also helps us point out if price closed below or above or at an area of interest. So let's say we have some sort of ordained price structure where we say, hey, Bitcoin is trading between 40,000 and 44,000. We want to specifically see when it's closing above or near that range or closing below or near that range, because if it breaks below that range, that might give more credence to the idea that Bitcoin's going to fall through that level, and maybe we might see lower prices in the near future. Whereas in reverse, if Bitcoin is frequently closing near that higher level, that might give greater credence that Bitcoin wants to remain at that higher level or surpass it. This goes along with our support and resistance lesson, so be sure to check that out. Now, some downsides for candlestick charts. So candlestick charts can be useful in giving a general idea of the price action of an asset, but they don't provide all the information needed for in-depth analysis. Candlesticks also don't show what happened in the interval between the open and close, the body, right? That main part, we don't know exactly what happened in between there. They will only show the distance between the 2 points, the highest and the lowest prices of that time period. For example, wicks can tell analysts the high and low price of the time period, but they don't tell us which one happened first. This can be alleviated by changing the time frame of the chart, so it's important to not rely on only one time frame or only one perspective of the market. And this is something that, as you grow more comfortable with looking at charts and grow more advanced in the field, you'll be able to easily transition between different time frame charts, transitioning from higher time frame and working your way down to lower, or in reverse. As you get more advanced, you'll be able to tell the differences and see how they all fit in and basically paint the same picture. Now, important to note is that lower time frames such as the 5-minute or even lower can appear very volatile, and it can be challenging to interpret. It's generally advised that beginners focus maybe on the daily and then work their way from there. Try not to focus on too many time frames at once because it can be overloading, but mainly focus on the daily and see what's try to make out what's happening on the larger time frames and the bigger picture of the market, so to speak. Now, candlestick charts are based off of what time frame you select. So this is a note on time frames. The daily chart, this is where we see each candlestick represents 1 day's worth of price action, whereas on a 1 hour chart, we see each candlestick represents 1 hour's worth of price action, and so on. This continues, whether it's weekly, minutes, 5 minutes, and so on. Higher time frames, or HTF candles, are made up of lower time frame candles, LTF candles. So let's say the daily candle each daily candle we can consider is made up of 6 4-hour candles, right? So a day is made up of 24 hours. And if we are comparing the daily chart to the 4-hour chart, we can consider, 6 of these 4-hour candles, because each one of these candles represents 4 hours, will represent 1 day's worth of time, 1 day's worth of price movement. 6 of these 4-hour candles. 6 times 4 is 24. There's 24 hours in a day. Now, if we wanted to take a look at the 4-hour candle, if we wanted to compare the 4-hour chart to the 1-hour chart, we could say that 4 1-hour candles is equivalent to 1 4-hour candle, right? Because there's 4 hours within a 4-hour candle, and so on. This will continue. So it's important to keep that context in mind. There's also an importance of candle closes. Candle closes can give weight or greater weight to a trade idea, especially the larger time frame. So the larger the time frame, the more important the close is. And think about it in terms of daily and weekly closes. These larger figures, these larger structures, closing and really giving strong indication of where price is going versus the 30-minute closes. And this is something that, there's so many 30-minute charts within the daily. So we could say there's 48 30-minute bars or 48 30-minute candles within a daily period of time. So each one of these 30-minute figures may be inconsequential in comparison to a daily chart, which shows such a bigger period of time. And in regards to that, it can be beneficial to wait for candle closes to enter a trade. And we'll talk more about trade entries in a future lesson, but it's something to consider, waiting for a candle close, not entering a trade in the middle of a candle structure. This is something I personally ascribe to. So let's say if I'm trading off the hourly chart, I won't enter a trade until the current hour candle has closed, or maybe if it has just opened, I'll consider it. But if it hasn't, and let's say we still have 30 minutes left, and my trade idea and my concept of the reasoning behind why I want to enter this trade was found on the hourly chart, I'm going to wait for that candle to close before entering that trade. And once again, it's advised that beginners should focus on a handful of higher time frames at first to avoid being overwhelmed or distracted by too much information. You could have information overload and things can get messy or confusing, and that's when you're overanalyzing and it's not really helpful. So it's suggested that you focus on the daily chart, maybe incorporate a secondary time frame to support your daily analysis, such as maybe the daily and the 4-hour, or the daily and the 1 hour. You're not limited to these suggestions. They're just recommendations. At the end of the day, you can do whatever you want, but this is just one place to start.